If you own a condo, your insurance works differently than a regular homeowner's policy. And most condo owners don't know that until something goes wrong. My name is Jim Eddington. I run an independent insurance agency called Western Pacific Insurance. We insure a lot of condo owners, and the number one thing we see is people who are underinsured because nobody explained how condo insurance actually works. Most condo associations carry a master insurance policy. That policy covers the building structure, the roof, the exterior walls, the common areas, the hallways, the elevators, the pool. It's the association's policy, not yours. But here's where it gets complicated. Not all master policies cover the same thing. Master policies are commonly written on bare walls, single entity, or all-in basis, and you need to know which one your association uses. A bare walls policy covers the structure up to the unfinished interior walls. That means everything inside your unit, the drywall, the flooring, the cabinets, the countertops, the fixtures, the plumbing, and the electrical from the walls in is your responsibility to insure. A single entity policy covers the building as it was originally built, including original interior finishes, but it doesn't cover your upgrades or personal property. An all-in policy generally covers more of the original interior finishes, but even with an all-in master policy, any upgrades or improvement you've made are still on you. Here's why this matters. Say a water pipe bursts inside the wall of your unit and floods your kitchen and living room. Under a bare walls master policy, the association's insurance may cover the common element portion or the part the master policy is responsible for. But everything else, the drywall, the flooring, the cabinets, the baseboards, the paint, that's likely on your HO6. Under an all-in policy, some of those original finishes might be covered by the master policy. But if you've renovated your kitchen 3 years ago, those upgrades are on you regardless. And here's something most people don't think about. This isn't just about the insurance policies. Your CC&Rs and association governing documents matter too, because those documents often define what the association insures and what you're supposed to insure yourself. The insurance follows the documentation. Most condo owners don't know where the HOA's policy stops and their policy starts. And that's exactly how you end up finding out you were underinsured after the water is already on the floor. Your condo insurance is called an HO6 policy. It covers your personal property, your liability, your interior improvements, and the parts of the unit the master policy doesn't cover. Here's the critical thing most condo owners don't understand. Your HO6 has a coverage limit for the interior parts of the unit you're responsible for insuring. You pick that number when the policy is set up. That number matters more than most condo owners realize. Because when a claim happens, the carrier is not going to say, "Don't worry, we'll cover the rest." If the limit is too low, the gap is yours. Let me give you a real example. Say you bought your condo 5 years ago, and your agent set the dwelling coverage at $50,000. At that time, that seemed reasonable. But since then, you've upgraded the kitchen, replaced the flooring, and remodeled the bathroom. The cost to rebuild everything inside your unit today is closer to $120,000. You're $70,000 short, and the carrier isn't going to make up the difference. Condo owners are some of the most accidentally underinsured clients we see. Not because they were careless, but because nobody ever sat them down and explained the split between the HOA's policy and their own. And construction costs have gone up significantly in the last few years, which makes the gap even wider. Your HO6 has 4 main parts. Dwelling coverage. This is the coverage limit we just talked about. It covers the interior of your unit, walls, floors, cabinets, countertops, fixtures, built-in appliances, and any improvements or upgrades you've made. Personal property. This covers your furniture, clothing, electronics, and belongings. If a pipe bursts and destroys your living room, this is what pays to replace your stuff. 2 things to watch here. First, the personal property amount on your HO6 is either entered by your agent or generated by the quoting system. And in either case, it's often set too low. On a standard homeowner's policy, personal property is generally set at 50% of your dwelling coverage. On an HO6, there's no automatic formula like that. The number is usually whatever someone typed in. If your agent defaulted to $25,000 and you have $80,000 worth of furniture, electronics, clothing, and your belongings in your unit, you're significantly underinsured on your stuff alone. Review that number. Second, most HO6 policies default to actual cash value on personal property. That means depreciation is taken out before you're paid. A 5-year-old couch that costs you $2,000 might only pay out $400. A replacement cost endorsement on your personal property changes that. It pays what it actually costs to replace the item at today's prices. This isn't standard on most policies. It has to be included when the policy is quoted. A good agent will try to add that automatically. Liability. If someone is injured inside your unit, your liability coverage pays for their medical expenses and any legal costs. This part works the same as a standard homeowner's policy. Loss of use. If your unit is uninhabitable after a covered loss, this covers your temporary living expenses, a hotel, meals, and other costs while repairs are being made. A quick note on water damage. Since that's the most common claim in condos, this is worth mentioning. Coverage depends on the cause of loss. A sudden pipe burst is typically covered. A pipe that's been slowly leaking for months may not be. Sewer backup usually requires a separate endorsement. And if the damage is caused by neglect or lack of maintenance, your carrier may deny the claim entirely. Loss assessment coverage is the coverage most condo owners have never heard of, and it can save you from a massive unexpected bill. Your HOA's master policy has a deductible. If there's a major loss, a fire damages the building, a storm takes out the roof, a water line breaks and floods multiple units, the association files a claim under the master policy, but the deductible on that policy could be $25,000, $50,000, or even $100,000. And who pays that deductible? The unit owners through a special assessment. If your association has 20 units and the master policy deductible is $100,000, that's $5,000 per unit owner, on top of whatever damage happened inside your own unit. And it's not just deductibles. If the master policy doesn't fully cover the loss, those costs get assessed to the owners too. You've probably heard stories of condo owners getting hit with $10,000 or $20,000 special assessments after a major event. That's what loss assessment coverage protects you from. Loss assessment coverage on your HO6 policy can help cover your share of that assessment. Most standard HO6 policies include a small amount, usually $1,000 or $2,000. That's not nearly enough. You can often increase it to much higher limits for a relatively small premium. But not all assessments are treated the same way. Deductible related assessments and special assessments can be handled differently depending on your carrier and endorsement. Ask your agent exactly how your policy treats these so you're not surprised. It's still one of the most valuable upgrades you can make to a condo policy. If you're coming from a single family home, here's the big difference. A standard homeowner's policy, an HO3, covers your entire structure at replacement cost. The carrier figures out what it costs to rebuild your house, and that's your coverage. A condo policy doesn't work that way. You're only covering the interior of your unit, and you're choosing the limit. The structure itself is on the HOA's master policy. So you have two policies working together. The master policy covering the building, and your HO6 covering the inside of your unit and your stuff. The risk with a homeowner's policy is that your replacement cost estimate is wrong. The risk with a condo policy is that your coverage A limit is too low and nobody ever helped you calculate it correctly. If you own a condo, do 3 things. First, get a copy of your HOA's master policy declarations page. Find out whether it's bare walls, single entity, or all in. That tells you exactly where the master policy stops and your responsibility starts. Second, review your HO6 dwelling amount. Walk through your unit and think about what it would actually cost to rebuild everything inside. Not just your belongings, but the floors, walls, cabinets, countertops, fixtures, and any upgrades you've made. If your coverage A limit doesn't match that number, you're underinsured. Third, check your loss assessment coverage. If it's sitting at the default $1,000 or $2,000, increase it. Talk to your agent about what makes sense based on the size of your association and the deductible on the master policy. If you want help reviewing your condo policy or you're not sure whether your coverage is right, click the link below and get a quote. Or just give us a call. We serve condo owners across Nevada, Arizona, Utah, and California, and we can walk you through exactly what you have and what you might be missing. Thanks for watching.